Hey, how's it going, insiders? Let me ask you a question. Let's say there's a top-tier technology company trading at $25. The company has a really strong fundamentals and you really want to add this stock into your investment portfolio. After you did a fundamental analysis, the intrinsic value of the stock is around $23. And on top of that, your technical analysis shows there's a very strong support level at around $22.50. So you believe that the best price you would pay for this stock is somewhere between $22.50 to $23. Now you have two choices. First, you feel a little bit of FOMO and straight away buy the stock at the current price of $25, which is about 10% higher than your ideal purchase price. Second choice, you can wait until the stock price to drop 10% and buy it at your best price, but the problem is the stock is a pretty popular stock and the price may never drop. So what would you do in this situation? Most of the beginners will be stuck between these two choices, and most of the time, they either ended up overpaying a lot more money on their favorite stocks than they're supposed to, or they missed the opportunity watching the stock price goes a lot higher without making any money. But what if I tell you, you actually have a third option, which allows you, if the stock price drops, you can buy it at your best price, but if the stock price doesn't move or even goes higher, you can also still make money. You might think such a technique is too good to be true, but actually this technique not only has been widely used by most of the hedge fund managers for many decades, but also is quite easy to be adopted by the retail investors as well. And this technique is called selling cash secure put options. In this video, I will show you guys exactly how selling cash secure put options work, why such technique is so powerful, and most importantly, how you can get your favorite stocks at the best price and at the same time make some consistent profits. At the end of this video, you will have everything you need to adopt this powerful technique into your own investing. Alright, let's get started. Let's do a quick recap on some of the option basics. So what is an option? An option is basically a contract that offers investors the right to buy or sell the underlying stocks at a predetermined fixed price within a fixed time period. This is the most important table and probably the only table you need to understand before you can use any option strategies. First, we have two types of option contracts, the call option and the put option. Then, we have two ways to place our trade. We can buy an option, which means we pay the premium as the fee to own the right. Or we can sell an option, which means we can get paid instantly as the premium income, but we have to carry the obligation. And this can result into 4 different scenarios. I won't spend too much time on this, but what I do want to highlight here is that the technique we're going to talk about in this video belongs to put selling. That means if we execute the trade properly, we will actually get paid to enjoy the opportunities to buy the stocks we like if the price moves into our favor. If you're completely new to options trading, I have uploaded my entire options trading course for beginners on this channel. It's completely free. Do check it out if you're completely new. I will leave the link in the comment section below. Alright, let's come back to the example we mentioned earlier. So there's a top-tier technology company that you always want to invest. Right now, it's traded at $25, but both of your fundamental and technical analysis are telling you the best purchase price to get in is no more than $23. Now, I will show you how powerful a cash secure put selling strategy can be in this situation. This is how it works. First, you already know your ideal purchase price, which is $23. Now, you need to set a time frame. Basically, it means within how many months you would like to wait and give this stock to fluctuate and hopefully drop to $23 so that you can buy. Usually, if the price differences are within 10% correction, like in our example, a 2 to 3 months time period will be the best. So in this case, we will use 3 months. Once we have our ideal purchase price and the time frame, now we need to go to the option chain and look for the put option we can sell. So this is the September option chain for this stock. On the left side is the call table, and then on the right side is the put table. What we're looking for here is that put option with the strike price that matches your ideal purchase price. In our case, it's the September put with the strike price at $23, which is a slightly out of the money option. Because we're selling this put option, the price we should look at is the bid price, because this is the price other traders will be paying you to buy these put options from you. In other words, this will be the instant income you can make right after you execute this put selling trade. Alright, once we know the strike price and the bid price of the put option we're going to sell, then the final decision is how many contracts we're going to sell. One thing you should keep in mind is that one option contract covers 100 shares of the underlying stock. Because our goal here is to buy the underlying stock at our ideal purchase price, we need to make sure that we will have enough cash to buy 100 shares of this stock at $23 if the stock price hits the strike price before the contract expires. That is why it's called a cash secure put selling. If we sell too many of these contracts and we won't have enough capital to buy the underlying shares, it will be called naked put selling, which is a pretty risky strategy and definitely wouldn't recommend it to any complete beginners. Alright, let's say our budget is no more than $2,500 on this stock and our target is to buy 100 shares at a price of $23. So in this case, we'll be looking at selling one contract of the September put at a $23 strike. Now, I'm going to use my option selling calculator and show you guys how powerful it is for our overall investment returns by just selling one piece of put option contract. These are the key inputs of this trade. One thing I do want to highlight here is that because the bid price for this put option is $2, that means after we sell one contract of this put option, we will instantly receive $200 into our account as the income. So once we put on this trade, these are the outputs we can expect over the next 3 months. I will break them down into two important scenarios. Scenario number one, if the stock price stays above $23 over the next 3 months, our put option will expire worthless. We won't be able to buy the stocks at $23. However, we can keep that $200 premium income as the free money. So that means this one single put selling trade made us 9.5% return over a period of 3 months. That is an amazing almost 44% annualized rate of return compared to the historical S&P 500 annual return of just around 9%. Let's take a look at scenario number two. If the stock price drops below $23 over the next 3 months, then our put option will be exercised, and we're obligated to buy 100 shares of this stock at $23. In total, it will cost $2,300. But remember, we have already collected $200 as the instant income at the very beginning when we sold this put option. So that means we only need to prepare $2,100 to purchase our favorite stock at the best price. In other words, by selling this put option, we effectively lower down our average purchase cost basis from the current price of $25 to just $21. That is a huge 16% discount to buy our favorite stock. If we do some comparison between selling cash secure put options at $23 and directly buying the stock at $25, we can find two very interesting highlights. First, if we directly buy the stock, we need $2,500 as the initial capital. But if we buy this stock using cash secure put selling strategy, we only need $2,100 because our strike price is at a $23 and we also make $200 by selling the put. Second, when we directly buy the stock at the current price of $25, if the price starts going down and it goes below $25, we will have instant losses. However, as we can see in this option calculator, if we use the put selling strategy, we will only start losing money when the stock price goes below $21. So which means by selling one put option, we indirectly give ourselves a huge 16% margin of safety on the price. If we execute such high quality put selling trades over and over again on the high quality stocks, we can significantly increase our annual returns over the long term. In fact, if you're a dividend focused investor, you are definitely familiar with all these so-called high income dividend yield ETFs from very famous institutional fund managers like BlackRock. Now I can tell you the secret behind all these ETFs that can generate really high dividend yield is actually by applying very sophisticated cash secure put selling strategy. With their huge capital size, such strategy allows the fund managers like BlackRock to either generate really high monthly premium income by selling put options on those low beta, high quality dividend paying stocks, or accumulating those stocks at a ridiculously low price to boost their long-term yield. Of course, no matter how powerful a trading strategy is, there are always some limitations. For this cash secure put selling strategy, there are two major limitations for retail investors. First, because it's a cash secure option strategy, which means we need to make sure that we will have enough capital to cover 100 shares per contract just in case those option contracts get exercised by the expirations. In other words, if the stock price is too oversized, for example like Amazon, with the share price over $3,000, it may not be suitable for using this strategy if our initial budget is only around $20,000. Second, if you are extremely bullish on one stock and you believe this stock will only go up and it will never come back down, then selling put options will not be the best strategy for you. The main reason is pretty simple. Your maximum return by selling put options would be capped at your initial premium income. No matter how high the stock price will go over the next 3 months, 6 months, or 12 months, you won't be able to enjoy the bull run if you are holding cash secure puts and waiting for the price to drop. But of course, there's some other great strategies to help us take advantages of those extremely bullish stocks, which I will definitely share with you guys in the future videos. If that is something you would like to learn more, please turn on that notification bell so that you won't miss out any of my future videos to help you make more money in the market. Alright, that will be the end of this video. Please let me know in the comment section below if you're enjoying this video. Also, if you want me to cover any other topics or markets, or if you have any questions, please let me know in the comment section as well. I would definitely love to hear from you guys and make more valuable contents to help you guys through this channel. Again, if you are new to this channel, my name is Vic. Thanks so much for watching, guys, and I will talk to you guys soon.